Cold open. Let's reset the narrative. This wasn't fundamentals. This was forced behavior. A 4-digit silver price sounds absurd in a stable system. It sounds like fear-driven fantasy. But markets don't move on belief. They move on margin rules, collateral demands, and positioning stress. When liquidity fractures, price doesn't drift higher politely. It reprices abruptly. If recent volatility made you uneasy, that isn't weakness. That's awareness. Nausea in markets usually signals instability beneath the surface. Repricing events begin when paper promises expand faster than deliverable supply. That imbalance doesn't resolve emotionally. It resolves mechanically. This is not a prediction of a number. It's a conditional pathway built on stress dynamics. We are entering a decision window, and there is one signal that will determine direction. We measure stress points. We do not chase numbers. So what actually happened? It wasn't retail enthusiasm. It wasn't a viral narrative. It was positioning stress inside the futures market. Leveraged longs increased exposure into strength. Commercial participants maintained large short positions. That created a crowded structure on both sides. At the same time, open interest expanded while registered inventory drifted lower. That combination matters. When paper claims per ounce rise while deliverable supply tightens, sensitivity increases. The market becomes fragile. Small shocks create disproportionate reactions. Delivery notices began trending higher relative to shrinking registered stocks. That suggests more participants are standing for delivery instead of rolling contracts forward. Layer on tightening dollar liquidity and rising bond volatility. When yields move sharply, collateral values shift. When collateral shifts, margin requirements adjust. And when margin requirements rise, weaker hands must either post capital or reduce exposure. That reduction is rarely orderly. Meanwhile, industrial demand continues quietly in the background. Solar manufacturing, electronics, electric vehicle supply chains, they don't pause for futures volatility. They absorb supply steadily. ETF inflows can create headline demand, but vault withdrawals tell a deeper story about availability. Price spikes don't begin because buyers cheer. They begin because sellers hesitate or disappear under collateral pressure. When open interest rises while inventories fall, the structure tightens. The next 14 days could determine whether this evolves into structural stress. When leverage meets scarcity, price doesn't negotiate. It reprices. Why did it feel violent? Because this wasn't about value. It was about liquidity. In thin conditions, order books are shallow. When heavy volume hits a shallow book, price travels farther than logic would suggest. That isn't manipulation. It's structure. Algorithmic systems detect momentum and amplify it within seconds, both up and down. The move feeds itself. Margin clerks don't debate narratives. They calculate exposure. If collateral drops or volatility spikes, requirements rise. Traders who cannot post capital must exit immediately. That's forced selling. It doesn't care about long-term conviction. It simply closes risk. Stop-loss orders accelerate the cascade. Large funds de-risk simultaneously when bond yields surge or equities wobble because risk models are correlated across assets. Silver becomes collateral. Psychologically, this phase is exhausting. It keeps you staring at every tick, questioning conviction. But volatility here is not random hostility. It's stress in the collateral system. And forced sellers eventually run out. When they clear, behavior changes. There is often a compression phase right before expansion. Volatility isn't chaos. It's leverage being flushed. Now, let's separate fact from interpretation. Fact: registered inventories have trended lower relative to recent history. Interpretation: a tighter float increases sensitivity to delivery demand. Fact: open interest remains elevated compared to prior quiet periods. Interpretation: more paper claims per ounce increase the potential impact of forced repositioning. Fact: retail premiums spike during stress. Interpretation: distribution strain, friction, not necessarily permanent scarcity. Fact: margin requirements rise when volatility expands. Interpretation. Forced behavior increases as weaker participants reduce exposure. What is not evidence of four-digit silver? A single breakout candle, a trending hashtag, a dramatic headline. Price alone is insufficient. This is probability stacking. Conditions first, narrative second. Now we enter the decision zone. Above us sits a multi-year resistance band, a region where prior advances failed. It's not magic, it's memory. If price approaches that band again, the reaction matters more than the number. If price breaks resistance and open interest expands, that signals new participation. If price rises while open interest contracts, that often signals short covering, a fake breakout. A true washout looks different. It's a violent spike lower on extreme volume, often paired with rising retail premiums and heightened bond yield volatility. That divergence signals forced liquidation in paper markets, not collapsing physical demand. Levels don't matter. Behavior at levels does. Now let's address the divide most people sense but rarely quantify. Paper versus physical. The futures price reflects leverage contracts. The retail coin price reflects fabrication, distribution friction, and immediate availability. In calm conditions, the gap stays modest. During stress, it widens. Register inventory is metal available for delivery. Eligible inventory meets standards but isn't committed. The distinction matters. If registered stocks decline while open interest stays elevated, sensitivity rises. Delivery requests convert paper exposure into physical obligation. ETF flows add another layer. Inflows imply demand, but simultaneous vault withdrawals suggest metal leaving accessible pools. Industrial users remove float quietly through forward contracts. Retail removes it visibly through hoarding. Physical drain is rarely the spark. It's the slow fuse. If premiums rise while price stalls, pressure builds beneath the surface. Paper trades fast. Physical moves slow. Then suddenly. Now let's map the pathways. Path 1. Sustained breakout. Price clears resistance. Open interest expands. Dollar schulfens. Yield stabilize. Momentum funds allocate. Positioning drives price beyond traditional valuation logic. Path 2. Fake breakout. Price spikes above resistance, but open interest contracts. Margin hikes follow. Liquidity tightens. Weaker longs exit. Price retraces sharply. This feels like failure. Mechanically, it's leverage compression. Path 3. Washout then higher. Violent drop below support on extreme volume. Retail premium spike. Delivery remains firm. Weak hands exit. Open interest stabilizes. Inventories trend lower. A base forms. The reversal, if it comes, is stronger because leverage has been reset. None are guaranteed. They are conditional sequences. And the washout scenario is often where generational moves begin. But analysis means nothing without discipline. Volatility provokes reaction. Emotional trading compounds errors. Scaling differs from chasing. Scaling is measured allocation. Chasing is urgency driven by fear. In leveraged markets, that difference determines survival. Liquidity planning matters because margin rules can change overnight. Patience during consolidation feels inactive. It isn't. It's observation. Observe behavior. Confirm signals. Respond proportionally. Survival precedes opportunity. So what do we watch now? Price relative to open interest. Registered inventory trends. Retail premium behavior. Margin rule adjustments. Dollar index direction. Bond yield volatility. ETF inflows and vault withdrawals. We are inside a 14-day decision window. Compression often precedes expansion. If we get another margin hike while price stabilizes, behavior could shift rapidly. If inventory drops sharply during sideways price action, sensitivity increases further. Signals first, narratives second. And when people talk about four-digit silver, understand what that actually means. Not hype, not fantasy, a stress outcome, a repricing event. It would only occur if structural pressure inside the paper market collides with tightening physical supply. It is conditional. Now I want your assessment. Is the next major move more likely to come from a slow physical drain or a sudden liquidity shock? And if volatility expands again, would you prefer a sharp washout to reset leverage or a direct breakout through resistance? We will continue monitoring calmly, without emotion, as this decision window unfolds. Because if collateral stress intensifies while supply tightens, the next move won't drift.